you could have a big problem because in the short term, it is possible prices could go down. Rents could go down. You have people move out the wrong time of year and you have a vacancy for a few months. So I'm big on not trying to have all that volatility and have all that fluctuation in it. I'd rather keep good tenants that keep your properties nice and play it for the long haul. Cash flow is the lifeblood of real estate investing, not appreciation. If you're a potential investor or looking to do a 1031 exchange and move money into Northern Nevada, here is what you need to know. When it comes to building a sustainable and profitable real estate portfolio, relying solely on property appreciation is a huge gamble many cannot afford to take. In today's volatile real estate market, investors who ignore cash flow risk not only their financial stability, but also their future growth opportunities. And as we explore the debate between cash flow and appreciation, we'll uncover 3 crucial ideas that could make or break your investment strategy. If you're an investor and you're thinking about buying rental property here in Northern Nevada, please subscribe to the channel. We put all kinds of great information about all the things that you would need to know about Northern Nevada and what might make great sense for an investment for you. So idea number 1 is having a predictable income stream. So let's talk about what a predictable income stream is. Cash flow provides steady income that you can rely on month after month. And this is especially important in economic downturns, when property values may stagnate or even decline. Without a solid cash flow, you can find yourself struggling to cover mortgage payments, maintenance costs, and other expenses, jeopardizing your entire investment portfolio. So we're talking about cash flow. This is where I see a lot of people get in trouble. I see other content and other videos where they get all up your ass about, hey, I bought for this. I put my 20 or 25% down. I like to put 25% down. I know many lenders will let you put 20% down, but you're trying to make that cash flow for what you can rent it for versus what the actual payment is, to me, as big as you can. And what they will tell you is the second you build up some equity, maybe you get 40, 50, 60% debt to equity, refinance it, steal all the equity out, and go buy another property. And you can do that, but you have to be very careful because I watch a lot of people back in 05, 06, 07 lose tons of rental property because they over-leveraged themselves. They went way too heavy on the, let me just get another one and another one and another one. What I've also tried to do is I started doing this, and because I live here, I help people buy and sell real estate here in Reno. I also own an office building here. I have a property management business here. It would make sense that I would buy rental property and invest here, but I'm so heavily dependent on this market that I started buying rental property in other markets. And when I first started doing this, I have 3 or 4 rental properties where literally my interest rates are under 4.5%. And to me, I'd be crazy to steal the equity out of those and refinance them into these higher rates. Because again, those first 5, 7, 10 years of your mortgage is when you're paying the most interest anyway. I bought a rental last year, and where I buy them in the Midwest, I bought homes anywhere between $180,000 and $250,000. And my ones that I just bought, I bought one last year, my interest rate's 7.25%. My positive cash flow on that one is just under $400, where my ones from 3-4 years ago are pushing $800-900. And so you have this nice, I look at it as the big group together. And so what you want to do to me is I have an account, and as that cash flow and that extra money every month versus my going out money and my coming in money, I just keep building up that account. Because the other thing that people forget about is if you own 6, 7, 8, 10 houses, or you own an apartment building or a fourplex, eventually things wear out. So whether it's new heaters, new air conditioners, appliances, a roof, just general maintenance when people move in and out of properties, you got to make sure ideally that your cash flow and your money coming in and out is allowing you to reinvest into those properties, allowing you to keep them nice, keep them clean. I'm a big fan of single family homes, and as long as you're buying 4 units at a time or less, it's still normal or traditional financing. Once you get 5 units and above, it becomes more commercial financing. So those become a little bit different if you're looking at 8plexes or big apartment complexes, things on those lines. So just know, don't overly limit your cash flow. That is what's going to keep you in this game for the long haul, so that if you do have a vacancy 1 month, or you do get an unexpected expense that you weren't finding that was going to happen to you, it just allows you to be able to sleep better at night and do all those kind of things. So by doing this and building up that cash account with your cash flow in it, it also allows you to keep the properties well maintained, in good shape, which typically gives you better, higher paying tenants. And honestly, I'm a big fan of, I'd rather not raise the rent $100, $200 trying to get more rent from somebody. It's amazing how quickly 1 month of vacancy or 1 month of some serious repairs, it just blows all your cash flow, the whole thing. So by doing that, you're mitigating your risk. That cash flow is super crucial, because if all you're relying on is appreciation for the long term and you just keep refinancing, you could have a big problem, because in the short term, it is possible prices could go down. Rents could go down. You have people move out the wrong time of year and you have a vacancy for a few months. So I'm big on not trying to have all that volatility and have all that fluctuation in it. I'd rather keep good tenants that keep your properties nice and play it for the long haul. All right, so with all that being said, people now want to know, and I think people focus too much on only buying rental property in their local market. And again, for me, I wanted to diversify out of the area because I'm so heavily real estate dominated where I live in Reno in Northern Nevada. But people always ask me, how do you know about properties or what would be good rental markets in other parts of the country? You have to remember, I know RE/MAX agents all over the country. I've been an agent for 20 plus years. And through some of the businesses I work with and the coaching company I work with, I know realtors everywhere. And so for those that I talk to that they say, hey, I live in an area that is a great real estate market for rentals, I start reaching out to those people. So you want to know, when you research these areas, you want to go through the neighborhood trends and property values and rental rates and know what are the future development plans. You want to understand how their market, how it all works and what opportunities are out there so you can do those things. So as an example, the house I currently live in was a rental house of mine that I moved into. At the time, that house, when I first started buying rentals in the Midwest, my house was worth $675,000 and I could rent it for $2,700. And what I did is I went to the Midwest. I was able to buy 3 houses, and on a total fluke, it was exactly $675,000 as well. But those 3 houses rented for $5,200. So you can see I was getting way more cash flow for the same amount of net worth or same amount of property value that I had. But at the same time, those houses in the Midwest most likely will not appreciate as much as my property would here in Reno. Now, with that being said, I'm in my 50s. I'm trying to get as many properties as I can paid off because I want more of the cash flow than I am worried about the long-term appreciation. So it just depends. Again, it's sitting down, having that conversation, figuring out if you want to start investing in real estate, how do you want to do that? And I know for a lot of you that watch these from California, a lot of times you guys own properties that are free and clear, and you can come buy properties here doing a 1031 exchange using cash. And of course, at that point, the properties are going to cash flow really well. But again, it's hard right now in Reno if you're putting 20 or 25% down to get a rent high enough that's going to make your property cash flow. Hey, investors, if you're thinking about moving some money and buying rental property here in Northern Nevada, click the link in the description below. It'll give you access to our buyer's guide that'll get you started on your journey and the things you need to know about buying real estate here in Northern Nevada. So just like any real estate, location is super important. And one of my personal preferences is I have an age limit that I don't like to go more than 20 years old for a house. And I always look at it, would I be willing to live in that house if I had to? So that's for me. I know lots of people that buy rentals around the country where you can find them for under $100,000 in not the greatest areas and they cash flow. And that's a game I don't personally want to play. I used to own one old property over in Sparks, and it worked out great for a while, but I just got tired of dealing with repairs and other things. So I've gone to much newer properties. But to me, you want to be just like if you were looking to buy for yourself. Good areas, good schools, low crime rates. If you need public transportation or you want to be close to amenities like shopping centers, parks, hospitals, location definitely affects those things and affects your rental amounts, especially depending on where people might work and those kind of things. So those are things you want to lean into that local expert. So if you're someone who lives here in Reno and wants to talk to me about those things, great. If you're looking in other communities around the country, or let's say you're someone watching this video and you're thinking about moving to Reno, but maybe you want to keep your house where you live, just know we can put you in touch with property managers, and you have 3 years. As a primary residence, as long as you've lived in it 2 of the last 5 years, it still counts as a primary residence. So you could take a house rented for a year or two because maybe in your market it's not a good time to sell, and you could sell it 2 years from now and it would still count as a primary residence, and you wouldn't have to pay capital gains taxes up to $250 or $500 depending if you're an individual or a couple. So just know that is something that you can do. So the big thing on any of these properties, of course, is again calculating that cash flow, and you want to ensure that the property is going to generate enough money for that. And so what I typically do is when I talk to my lenders, same thing we have clients when they want to buy rental property here, is want to figure out how much you're paying for it, how much that actual mortgage payment's going to be each month, things like property taxes, insurance, what some of the maintenance or management fees for a property manager might be, and make sure there's enough rent there to offset all these things so that you're not negatively cash flowing. Of course, back in the day, we had that happen a few times where somebody wanted to keep a property. If you're negative $100 or $200, not the end of the world, but it is not a way to build up a long-term portfolio. So you want to diversify those things. And so I'm a big fan of not putting your eggs in all in one basket. I own a commercial building. I own a property management business. I own single family homes. Someday I might get into the multifamily, duplex, fourplex, those kind of things. But for me and my market here, we don't have a lot of those that aren't really old, and I'm not a fan of older properties. So I'm going to stick to the 20-year and newer single family homes. That's my way of reducing risk and repairs and those kind of things. So other big thing is leveraging your financing wisely. So you have to be real careful. I keep telling you, hear these gurus who keep saying, hey, as soon as you build up some more equity, refinance that thing and steal your equity out of it and go buy another property. And that's why I saw a lot of people get into a lot of trouble. So I'm a big fan of fixed rate, conventional 30-year mortgages, so you know what that payment's going to be. The only changes you're typically going to see is if HOA fees were going to go up, or if property taxes change a little bit, and you're going to have minor changes in some of those. Of course, typically over the long haul, rents will go up the same as those kind of items will go up, so you're typically able to keep that current, ratio of how much debt to equity do I want to have in the property and how much cash flow do I want to create, but you got to be careful of doing it too much. I like to get my properties up to at least 40 or 50% or more before I would ever consider refinancing them. And of all my rental properties right now, I've never refinanced any of them. I typically try to just build up a bunch of cash reserves, and once my cash reserves are at a certain level, then I'll just go typically buy another property. And when you're doing your due diligence, treat it, like I said, as if you were buying to live in this house. You're going to do all the same inspections. You're going to do all the same appraisal. Treat it as if you were going to have to live there, or you were going to put your mom or your sister or your kids and they were going to live there. And my philosophy on that is if you treat it that way and not as just some rental house in a different part of the country, and for lack of a better description, you want to just slumlord it, I wouldn't do that. I kind of feel like it's easier to maintain and keep a house nice than it is to have a house fall apart. I would say it's easier to stay in shape than to get in shape. So if you can do those things and ideally have an amazing property manager, that is the biggest. I looked at multiple markets when I started buying my rental property, and I went in a certain city because that property manager was thorough. He was on the same page with me. And because I do this for a living, I knew exactly what I needed from him. And because of that, now we're on a great page. I deal very little with my rental properties in other parts of the country. And so that's the way I like to do it. You can always manage this stuff yourself, but I always feel like only do that locally. If you have properties that you live in a city and you manage property locally, do that. But if they're in other markets and other communities, especially for someone like me, I have a real estate license, I have to have a property manager. I think it's just a better, and it's honestly the best money you can spend. Most property managers are roughly 10% of the rent. Some of them other fees depending on what the rents are in different parts of the country. But just know that is a huge factor in what you're doing with all of this. So where that property manager becomes so important, and this is where I think people really mess up, is screening the tenants carefully. You want to have a rigorous screening policy. My property manager, they manage over 1,000 homes, so they've got a good policy. They do the credit checks and the rental history and make sure if they talk to any of their previous landlords, you want to try to get references. And I'm telling you what, good tenants, they stay longer, they treat your house nicer, and these property managers can stay updated on the laws and regulations and all the things that you need to know. Again, for those of you, some of you are out there thinking about doing short-term rentals and Airbnbs and can you and can't you. Most property managers like myself, I can't manage short-term rentals. Typically, most of us have to be at least 30 days or longer. That's what my license allows for. But those property managers are worth their weight in gold, and everyone I know who has good ones, like I said, those are the cities and those are the places to go to. If you're someone in another market that wants to get into it where you live, reach out to me. I've got great contacts all over the country. We can definitely walk you through the process, how it all works, but every state's a little bit different on how that works, and that's why that local property manager is going to be the one that you're definitely going to have a great relationship with. So with all rental property, you have to plan for the long term and be patient. Obviously, that appreciation is a long, slow growth. You want to pay attention and monitor trends and adjust your strategy if you need to. But again, based upon what age you are, what your current goals are. I know when I was younger, I was trying to be in markets where I would get more appreciation. Now I'm worrying about cash flow. While appreciation is kind of my long-term wealth building strategy, ideally, I'm looking more for cash flow. So if you have questions about how to do this, why you should do this, like I've always said, real estate is the number one way that people get wealthy. So I never say don't do it with the stock market, do both. But if you're trying to figure out how to get involved in this and how to do this, there are lots of markets, so don't just singularly focus on where you live, and just know we can walk you through the process. So reach out with your comments. We're happy to help you. Hey investors, if you're thinking about buying residential real estate property here in Northern Nevada, check out this video we did about all the best neighborhoods and things you need to know before you get started.